Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
Good morning. Welcome in for another edition of Retire Right with Rick Durkee. I am your host, Shane Griffin. Each and every Saturday morning here at 9 o'clock, I have the privilege of sitting down with our local retirement, income planning, and wealth distribution specialist, Rick Durkee, to help you to retire right. Happy early July 4th to you, sir.
Bang! Gotcha, didn't I?
Yes, you did.
I wonder how many other people I woke up out there. Sorry, y'all.
That's what you call a loud firework early in the morning, 2 days before July 4th.
Well, that reminds me of a quick story of when I was a young lad.
Okay.
We were, I don't know if people know this about me or not, but I moved to Rock Hill, South Carolina when I was 16. But I lived in the Midwest before that. And when we were kids, we couldn't get fireworks. We couldn't get explosive fireworks in Illinois. That was illegal.
In the whole state?
Yeah,
wow.
The whole state. So anybody that visited any place, that they had fireworks certainly brought them back for us kids. So one year, one of my friends brought back some Black Cat firecrackers.
Oh, I remember those.
And
absolutely.
They had good pop to them, and you'd get a belt of them and light them up and run away and. And so we had a great time with that. But anyway, I lit, and then you'd go back to where the belt was, and you'd find a few that didn't blow off.
Sure, right.
Okay, of course they had shorter fuses.
That's right.
So I lit one, and it just went bam right in my hand, and I was just
my goodness,
that hurt. But anyway, so that's a childhood memory from. Doing illegal fireworks in Illinois, and now I live in South Carolina since I was 16. And hey, we can blow them off as much as we want. When we were in high school, we used to get the tubes from hangars and then get bottle rockets, and we'd play Army, and we'd go around. We'd put goggles on, of course, but we'd go around shooting each other with bottle rockets.
Holy smokes!
Tie 3 or 4 of them together and shoot
I used to put mine in the big 2-liter Pepsi bottles. Put the bottle rockets in the Pepsi bottles, stand them up straight and straight up in the air. That's how we would enjoy the bottle rockets.
Oh, kids' funs and kids' memories. So,
yes,
hey,
absolutely.
If there's any kids out there usually aren't listening to Retire Right, but be careful with those fireworks, all right?
Absolutely.
Or if you're kids that never want to grow up, adults that are going to play with the firecrackers this weekend.
Well, it is July 4th weekend, and boy, the Founding Fathers would look at us now and go, what in the world is going on?
Yeah.
Not to get political, but it's interesting how things have changed over the past couple of 100 years.
Well, happy 4th. Happy Independence Day
to
all of our listeners today, and look forward to this summer.
Absolutely.
This is really the kickoff for summer, isn't it?
Summer is definitely in full swing. The topic this morning, Rick, life insurance can help with retirement planning. Before we jump to that, though, a couple of reminders. You can listen to past programs of Retire Right with Rick Durkee at the website, cfpgroup.biz, and also at our website, 943wsc.com. If you heard something you want to hear again, if you missed the program or had to leave early for whatever the case, you can go back and listen to the podcasts on those two websites. Also, if you'd like a transcript of the program, you can request that through Rick's office. You can call 843-735-5065, 843-735-5065, and also many events throughout the course of the year. Be sure to check the calendar of events. And Rick, you just finished up some Social Security workshops in June, which I hear were very successful.
We did. A lot of good educational information. I know it's early. I want to promo this ahead of time. Last year, we did our Retirement Planning Summit.
Right.
It has been scheduled for this year. Folks, mark your calendar right now, October 27th, all day long. We are going to have several speakers, national speakers here in Charleston at the Coastal Financial Planning Group meeting in our conference center. We have Typically, in the past, last year, we scheduled half-hour speeches from different speakers, and we have a conference room that'll house probably as many as, I think in one of the meetings we had 60 people, standing room only. So a lot of good information. Just please mark your calendar now for October 27th. It's a Thursday.
Right.
Hopefully we'll have good weather, because up on the rooftop of our building there, we'll also have some refreshments and an opportunity for you to mix and mingle with our speakers. So. And
you also had a heck of a DJ last year, if I remember correctly.
I think we did.
I'm sure he'll be back.
What was his call? What did he go by? SG? SG?
DJ Shane would be your entertainment tonight.
Yep.
So, yeah, mark your calendar, October 27th for the Retirement Summit at the Coastal Financial Planning Group. I attended that last year, and there was really a lot of great information. So if you can make it, mark your calendar. It is still a few months away, but just put that on there and as a reminder to attend that great event.
Hey, one other thing I'd like to remind our listeners is we do publish a weekly newsletter on financial topics and the markets, reports on the markets and what's going on. If you'd like a copy of that newsletter, certainly email me, rick@cfpgroup.biz, or visit the website, and you can register online for that newsletter, and we'll keep you up to date on what's going on in the markets and investment topics. It also refers you to the website with our articles for the month. So several articles that we probably over the course of the next few months, too, will be discussing over the radio.
And I'm on that list. A lot of great information. It's a quick read. Lots of good links in that. So, again, if you'd like more information, email rick@cfpgroup.biz, rick@cfpgroup.biz. So let's jump into it. The topic today, life insurance can help with retirement planning. In an article Rick posted at investmentnews.com, Greg Lasuri writes about how cash value life insurance can help with retirement planning, could prove to be a valuable asset for clients looking to couple an insurance need with tax and portfolio diversification in retirement. There are things, however, to keep in mind when considering cash value life insurance to make sure it's being used correctly and, of course, is in the best interest of each person's situation. First, Rick, let's walk through the different types and flavors of life insurance and how best they can be used in retirement planning.
Well, okay, let's do an analogy here. Vanilla, strawberry, and chocolate ice cream, right?
Okay.
Neapolitan flavors. Okay.
Napoleon, right?
All right, Napoleon. Neapolitan flavors. In life insurance, you have basically two flavors, okay? You have term insurance and you have permanent insurance. Your term insurance is an insurance that you take out for a specific term period. Okay. Some people use term insurance to protect a mortgage, perhaps. You know, you take out a 30-year term so that if you die during that term period, your mortgage would be paid off to your beneficiary. One thing to keep in mind here, because you mentioned it, tax implications.
Sure.
Death benefits in life insurance are income tax free. A lot of people don't realize that, so it is a good tax planning tool for legacy planning. If you're going to pass on an asset, wouldn't your beneficiary rather receive that asset tax-free versus taxable? And in life insurance, the cash value of life insurance can be withdrawn tax-free, and also the death benefit of life insurance is always income tax-free. So I just mentioned the second type of insurance, life insurance, permanent or cash value life insurance. Cash value means that there is some value that you can access during your lifetime inside of that life insurance policy. If you perhaps need it to supplement income in retirement, if you need it to help fund a child's education, perhaps college education, if you just need it for whatever purpose, you can withdraw that money under loan provisions. And let me explain how those work in cash value life insurance. You can withdraw under loan provisions where typically after about 15 or 20 years of holding that cash value life insurance, so if you're going to use it again for a college education, you'd want to start it up real early when your children are first born. But after about 15 or 20 years, the insurance company basically forgives loans as far as interest that's charged on the policy because they wash.
Okay.
The interest is still paid on the money while you have it outstanding on a loan. Okay, it's still paid by the insurance company. There's a minimum guaranteed interest that's paid, and then they charge you an interest on the money while it's outstanding, and they typically wash after 15 to 20. Folks, I'm speaking in general.
Yeah.
I'm not speaking about any particular company's products or anything like that. You certainly need to review the policy, illustrations, documents, things like that before making any financial decisions regarding life insurance. But I'm just speaking in general here about how this tool of life insurance can be used. Cash value life insurance comes in different forms. You have universal life, you have variable universal life, you have fixed indexed universal life. All of these are just basically talking about how that cash value grows. And then you also have another form of permanent insurance called whole life. And it has guarantees as far as cash value.
Right.
It also pays dividends if you're with a mutual company. However, if the dividend is declared, it is an if. It's not guaranteed. So a lot of different ways these policies have been used over the years. Going back to the loan provision again, I'd like to say that money, when it does come out, is not reportable on your tax return. So it can be tax-free. But there's some situations that there's some situations that you have to be careful of too that can cause that money to become taxable later on if you're not careful. So regarding life insurance and using cash value during your lifetime, if you take the money out of the policy and you die, it will subtract against your death benefit. You can't have your cake and eat it too.
Absolutely.
Okay? You can use the cash value, but then your beneficiary will not receive that portion of the death benefit. Okay? So it's an advance of the death benefit while you're living.
Gotcha. Let's talk about cash value life insurance and something that we've talked about on this program before, and that is sequence of returns risk. How can cash value life insurance help reduce the risk of sequence of returns risk?
Well, because in your whole life policies, for example, your whole life insurance has guaranteed cash value. So it doesn't matter what the markets are doing out there. You're going to have this guaranteed cash value growth that you have access to. And so you're not subject to sequence of returns risk if you're withdrawing money out through the loan provisions, because it's not, that cash value isn't going up or down. In a variable universal life policy where it's subject to market performance, you could have that sequence of returns risk. In a fixed indexed universal life, you won't, because it's guaranteed on the down years that the indexes go down, that you get a zero. And then on a guaranteed basis, universal life policy, meaning guaranteed that your death benefit will always be in force as long as you pay the premiums. Your interest rate, which is not guaranteed, could fluctuate, which could cause some sequence of returns risk as far as interest rate fluctuations go. So again, a lot of information. People are sitting out there saying, whoa, I just understood term insurance, and now he's brought up this permanent or whole life with cash value.
Yeah.
I'll just stick with the term. Folks, if you need protection, as Dave Ramsey would say, buy term. And invest the rest.
Right.
If you need some form of favorable tax planning, perhaps if you're a high net worth individual, or if you just want to guarantee a legacy, you got to use permanent insurance. Whether you're high net worth or not, if you want to create a legacy for your beneficiaries, you can't use term insurance, folks, because there's a little unknown fact out there. We always talk about critical unknown facts, okay? Less than 2% of term policies ever cash in for a death benefit. So it's a cash cow for the insurance companies, even though the premium's a lot lower than your permanent insurance. Look at the permanent insurance or cash value building life insurance is just transferring money from one pocket to another. You're paying more into it, but you have access to it.
Right.
And then you also have the more favorable situation of it's going to pay when you die. Permanent insurance will be in force the day you die.
Right.
Term insurance more than likely will not because of the statistics I just mentioned.
Now, let's talk about sequence of returns risk quickly. We kind of jumped over that and went right into how to use cash value life insurance to avoid that. But for someone listening this morning that has no idea what that is, what is sequence of returns risk, number one? And then number two, what I'd like to also have you do is give me a real-world example of someone you've helped avoid sequence of returns risk with cash value life insurance. So kind of a two-parter there. Okay.
All right. So remind me when I get long-winded on this first part that I have a two-part sequence of returns risk. It's becoming more and more prevalent in the industry to talk about this, in the financial services industry to talk about this, because boomers are retiring and starting to take withdrawals from their retirement assets. And the problem with sequence of returns risk is, well, number one, that it's never really been discussed.
Right.
People were in their accumulation years, and now they're in their distribution years. So we have to pensionize the money that is set up in these accounts. And so that means we're going to create an income stream, Shane. And if early in that process of starting the income stream we have poor market performance, it's going to, and we're withdrawing money, then it's going to deplete those funds faster than if we would have had positive performance early in the sequence of returns, and then be able to go through the lifespan of retirement. So the problem with sequence of returns risk is twofold. Number one, it's not being taught. It's a critical must-know fact that you do need to know about. I would suggest that people join us for our next upcoming next upcoming seminar by visiting the website and registering online, looking at our calendar of events. We go into some detail of sequence of returns risk. We will have a lengthy discussion about it in the fall at our income allocation workshop at the College of Charleston. But it's something that people aren't teaching retirees about, and it's something you need to know about. Now, as far as an example, and hey, folks, if you don't want to wait until then, call us today, 735-5065. I'll send you out a brochure on sequence of returns risk, and you can educate yourself a little bit more. Certainly, we'd love to present that to you in the office if you'd like to stop by and talk about your particular situation. So give us a call, 735-5065. Life insurance, sequence of returns risk. So we're taking money out of a life insurance policy now, and we're in retirement. And I'll give you an example of somebody that has used this. I have a client that wanted to delay their Social Security benefits. Okay. And they didn't have a lot of non-qualified assets, which is what we won't want to use, non-taxable assets to integrate into their income plan to provide the income they wanted to get. Anyway, they needed the income. They didn't want to take it from Social Security because they knew those benefits would increase over time the longer they delayed them. And they also knew those benefits were tax favored because they were going to be taxed less than their IRA dollars. So what we did when we did the complete analysis and found that they had some whole life insurance with some cash value in it, we were able to use that as a supplement. I see. As almost a bridge to get to 70 if they wanted to delay that long for their Social Security, and we were able to withdraw it out on a tax-free basis. Now, if that money had not been in a whole life policy, which I explained earlier, in the whole life policy you have guaranteed cash value, so you're not subject to sequence of returns risk because that cash value won't fluctuate. But if they were in a variable universal life, that a cash value is subject to market performance, and if that cash value would have been subject to some market downturns. Let's say that these people were funding this income in 2007 through 9 when the market's going down, then, of course, they would be cashing out shares in that variable universal life policy, which actually, without getting into a lot of detail, a variable universal life policy is going to be tied to market performance. It's going to be like mutual funds with inside of that variable universal life sub-accounts. So they're taking money out and the market's going down. They're having to cash out more shares to get those same dollars.
Right.
That means that cash value is going to run out faster because of early sequence risk, early market downturns.
Gotcha.
And that's just a situation. We don't know what the markets are going to do or when they're going to do it. Right now, people are pretty unhappy with market performance because it's kind of flat with a lot of volatility. But, you're drawing out during the year and the market's down 5 or 10%. That's a little sequence of returns risk. It's not a big one like a 30, 40, or 50% drop, but, it's going to have an effect over the long term of what your leftover money is going to be down the road, maybe 10, 15, 20 years into retirement. So there you go. There's sequence of returns risk and a pretty easy understanding example. Again, call us at 735-5065. If you're getting ready to do your income planning in retirement, let's sit down. Let's go through a 3-step review and talk about how sequence of returns risk might affect you if your assets are subject to risk.
We are discussing this morning an article found at investmentnews.com. If you'd like a copy of the article, you can email Rick at cfpgroup.biz. The article title, Life Insurance Can Help with Retirement Planning. Now, Rick, I know somebody listening this morning, I know I'm guilty of it, discredits an opportunity or even an idea because we really don't understand it. To me, cash value life insurance can be confusing. I'm listening to you talk this morning with your incredible knowledge of these products and these strategies and just thinking to myself, how do you keep all this stuff straight? So I think it's really a good opportunity for someone listening this morning that may not understand this product, may not understand this strategy, to at least come in and get more information and talk about more in depth some of the ideas that we've discussed here this morning, correct?
Yes, Shane. I would encourage people, first of all, to research the article. Google the article that you referenced this morning, Life Insurance Helps with Retirement Planning, but be aware of pitfalls. That's going to give you the positives and negatives of using life insurance. It's an unbiased article. It is like any person working on a fiduciary standard would want to work for providing information for potential clients, the good, the bad, and let them gather those facts and then make decisions as to whether or not this product that they've discovered is in their best interest or not to use for their financial plan. I would also say that what we have to do is look at those examples where somebody hears something like or researches on the internet and sees bad examples of a particular product or idea. Life insurance, in a lot of circumstances, has been sold with the intention of somebody building this cash value during their lifetime. And it was shown in the beginning that if you put this money in and you overfund above the cost of insurance in a permanent insurance plan of some sort, that you're going to have this cash value. But then life gets in the way, and
reality
maybe you stop paying those extra dollars in and whatnot, because it's not when you do.
You really have to be disciplined.
You do, because when you take out a permanent form of life insurance, if it's a whole life plan, you have to pay those premiums. If it's a universal life type of insurance, you don't have to pay those extra dollars that might have been proposed to build the cash value. It's flexible. And a lot of times then people say, well, I got an out here. If it doesn't work out, well, then guess what, folks? Your plan isn't going to work out either. And that's how sometimes I think life insurance might get a bad rap, is people don't follow through, and then implications happen that didn't follow the plan and their objectives, and then they're unhappy. I think, too, in situations where you're trying to use cash value building life insurance as a retirement income supplement, I think that listener out there right now that says, well, how and why would I do that? you're the type of person that maybe is max funding your 401k plan. You can't put any more dollars into retirement plans. Maybe you've decided that you just want to fund into your 401k the employer match, and then you want to find an alternative for the extra money.
Right.
Because remember, folks, when you put that money in that 401k, it's going to be fully taxable when it comes out. There's no loan provisions on that 401k.
Right.
You got to pay the taxes. In life insurance, you can. So it's just another tool that somebody that might be a little bit more well-to-do or higher net worth or want to create a legacy for someone that's tax favored would want to look into the details of how it works and whether or not it may be appropriate for them or may not be for their particular objectives of what they want and need their money to do for them. And
a real good step to recognize that is to come in for an exclusive 3-step review to find out, look at the entire plan and see if this fits in.
Sure, Shane. The 3-step review is a great way to assess things from a tax standpoint. How will this decision affect me tax-wise? We talked about life insurance and its tax-free death benefits, income tax-free death benefits today. So that would be just one thing that could come up in our conversations, depending on what you want and need your money to do for you in the future. Number 2 of the 3-step review would be, how will this decision affect me from an income planning standpoint? Could I use this tool for income planning? And do I want to? You know, I have several alternatives in what I could choose. How does this decision as to what financial product I use affect me from an income planning standpoint? And then thirdly, how does it affect me from a risk standpoint? The product that we talked about today, life insurance and cash value life insurance, has very little risk, folks. It has guarantees that are provided by an insurance company. You need to certainly research your insurance company decisions and make sure that they are good, A-rated or better insurance companies, and that the financial advice that you're getting to purchase it is in your best interest and not swayed to one company or the other. It's just going to be the best product for your individual situation.
To set up the exclusive 3-step review, 843-735-5065, the number to call. A reminder to check the website for the calendar of events. Lots of activities coming up through the summer and the fall and the end of the year. So you want to check that out, the calendar list of events at cfpgroup.biz. Rick, always great to see you, sir. Have a great July 4th weekend. We'll see you back here next Saturday at 9 o'clock.
Thank you, Shane. And hey, folks, one final tip. Throw that firecracker before it goes off.
Good tip.
All right. See you next Saturday, 9 a.m. for another half hour of Retire Right with Rick Durkee.